Felix here, and happy Monday to you. Election day, and that's also what is really the lead story for us here today, is shenanigans going on with regards to elections and data that's put out that's kind of screams, well, massive manipulation, really. And we've seen it a few times in the past. It's not a completely new story, but it might completely change the way the Fed acts, the way the market acts over the next couple of weeks and months, because there's some funny business going on here. Before we get into that, it's your last day to get your hands on America's 662 scariest stocks likely to go out of business, run out of cash. It's free. Go to the benchmark, felixfriends.org/662 before that benchmark disappears today. And of course, none of the following is financial advice. I want to share my screen with you, but it's sharing lots of screens of myself. So let's just do something about that, shall we? Okay, here we go. So this is what it's actually about. And what's going on here? Why am I in that corner? Here we are. Right, so you've seen these headlines maybe today on Bloomberg. Fed hasn't accomplished anything on the labor market. And that's what's been driving everything. We're like, why is this labor market so strong? How is that possible? And the mantra in the popular press is, labor market is strong, the American economy is strong. Isn't it amazing? I saw a bunch of tweets on exactly that yesterday. I'm like, really? Is it? Isn't it just all the money that was pumped in? But actually, there is a bit more to that. Now, there are two labor market surveys that we get. And the one that the Fed uses, the ones that politicians and the press talk about, is something called the establishment survey. This one here. That's basically the jobs numbers that we look at. So you've got lots and lots of, this is job creation. So this is job creation for recent period of time creation. Now, right here, something changes. These two surveys, the household survey, which isn't the labor department, and then the green establishment survey, which is the labor department, they massively deviate. And they deviate to the extent by now, over the last couple of months, of literally 2.3 million jobs difference. So the official government figures show that there are 2.3 million jobs out there, which the household survey says aren't out there. And that's kind of what gets us here. Look at the difference. Jobs created since March. This is the official. This is the, let's call it the Biden line or the Labor Department line. And you might wonder, why would they do that? Why would they have figures that are so very different from the household survey and possibly misleading? Well, there might be some answers here in the history. Remember when President Obama was running for election, we saw the same story. We got a massive gap here, the sort of 9 months leading up to the election. And I'm not political, honestly, couldn't really care less who runs the United States. I'm not a citizen, don't get to vote. And Trump versus Hillary, same story. Again, massive deviation. So it does seem to be rather convenient that these survey differences pop up just before elections and basically somewhat mislead us into thinking the labor market is much stronger than it is, because try running for office with high unemployment and high inflation. Well, that'd be a pretty tough line. At least you can say, well, the market's strong. Everyone's got a job. I did it. Isn't that brilliant? And don't worry about the inflation story. So if you look more deeply into the household surveys, what you see is that we are actually losing a ton of full-time jobs. And I don't know who it was, but one of you guys on the live chat on Friday kind of got me onto this thought, because they were asking, I'd love to see the breakdown between full-time and part-time jobs. And whoever you are, you were definitely onto something. Robert says, everyone knows Democrats don't lie to get elected. Well, I wonder whether it's political or whether it's just the administration. Okay, if you were an administrator, a government official, you like a big administration because it means you've got more money, right? You've got more power. That's generally the way it works. So they want to keep whoever in power who's got more money, more power, right? So literally, no one's opening my door. Give me 1 second. Okay, apologies for running off. That was actually Winston at the door returning from the forest. So back to this story, and I'm not a huge conspiracy guy, but this kind of is a strange one. So what did we get? We got part-time jobs, but we didn't really get any full-time jobs. Instead, we lost a ton of full-time jobs in October. The data we saw didn't show us that. So if you look at what's actually happened over the last 9 months, 6 months here, massive, massive loss in jobs. And this is not part of the official figures. Everybody got a part-time job because they needed to make some money. And then a lot of people not making enough money with their jobs, they're getting multiple jobs. And that's one way of skewing figures, right? You just count those as jobs. If you look at what's going on in the real economy, well, Lyft laying off 13% of workers, Open Door 18%, Stripe 14%, Chime 12%, Twitter 50%, Morgan Stanley some number, Meta just out. They're going to lay off thousands of people. Well, this is the Meta headcount since 2012. They've never, ever reduced headcount. Never, ever reduced headcount. And which obviously means there is a lot of wastage going on there. And people are going to get laid off. Unfortunately, at Google, at Twitter, at Meta, all at the same time, which means it's going to be really hard for those guys to find new jobs. It's like a financial crisis. It's just like a big tech crisis. So you then get these kind of headlines this morning. Morgan Stanley saying US midterms could fuel an equity rally because it could send yields lower, equities higher, but they see high volatility ahead of CPI election results. Now, what happens if this data we were just talking about up here comes out and suddenly there is a story out saying, well, not story, but the data comes out and says, job creation wasn't the 250,000 plus, it was like a minus 250,000. What happens then? Well, two things happen. One is that the expectations of terminal rates, so the Fed's interest rate comes down. We're probably going to go below 5 percentage points again. So smaller than 5 percentage points. What does that mean? That means you get a tech rally. Yeah, you get a tech rally, you know, the kind of ARC rally, the kind of stuff that's been really, really beaten up. That would go up. And then, you know what starts to sink in? You're going to have a week of euphoria. And then people are starting to realize, hang on a second. You mean this is going to be a real recession where people will actually spend less money and we might not get bailed out because we still have high inflation? Oh, we don't like that at all. And at that point, you would expect, you know, Dow, SPX, S&P, and so on to actually start going down. Tech stocks will still do a little bit better because that's so very much interest rate focused. So the 10-year-old, the 10-year yield, US 10-year treasury yield and tech stocks are basically perfectly inversely correlated. So it's good for tech stocks, but it won't be good for kind of the real world. So in the medium term, I still don't see where the stock market rally comes from. We might get a bit of a rally in the stocks that have been beaten up the most, you know, the tech space, but the real world who actually lives off consumers and lives off big companies spending lots of money on their products, I don't really see it. The sort of pie in the future sky because we're developing something that's going to cure whatever, they might do a little bit better because the current cash flow problem of the US economy won't really be their problem. But that's kind of the way I see it. And of course, that doesn't mean it's going to pan out exactly like that. But the discrepancy in data is enormous. 2.3 million jobs created since March this year, which kind of aren't there. So nice story if you want to get elected. And bear in mind, statistics are, you know, lies, and statistics. So you can always massage all bits of data. I totally get that. But this time the Fed won't bail out. No one says WND. Well, they will if they break stuff. But at the moment, they haven't broken anything yet. So if we get the bond market getting broken, liquidity drying up like the UK experienced, or, you know, big financial institution gets a bit wobbly, and insurance companies and things like that, that's when pension funds, that's when they start to step in, but not just because you and me are hurting with our stock portfolio, right? So that's not really what's going to happen here. Now, what isn't hurting in our stock portfolio is we're making very nice money on our options portfolio here. We're up 114%. I can't promise you that you're going to make exactly the returns that I make. That would not be honest of me. But I can promise you that I'll teach you everything that I know, and that I'll be completely frank and transparent and share all the trades as I do them so you can learn from the experience. If that sounds something that's interesting to you, to build an extra income stream, go to felixfriends.org/coaching, book a call with us, have a chat with us. We walk you through it to see how we can assist you to build an extra income stream in about 3 hours a week so you can maybe not work the extra job or scale down a bit, retire a bit earlier, live better, build a bigger portfolio, just generally enjoy your life more and, stroke your dog's ears more frequently. Check it out, felixfriends.org/options, links down below. And I forgot to mention, for those guys, for you guys, for the coaching, you need a 5-figure portfolio or 6 or 7 or 8 or 9. If you're not quite there yet, if you're just getting started, then come and check out the Master Options program here. That's the wrong. Yeah, there it is. 100 lessons pre-recorded. You get to see me trade every week, and you get access to my Master Options portfolio and daily chat support and everything else as well. So check it out. Our whole mission here is to make you better investors. That's really the whole story. I had a lovely chat this morning with some of our coaches as well, investment banking chaps. Anyway, let's move on here. Now, if you are in the business of brokerage, you're losing clients right, left, and center. Interactive Brokers lost about, what's that number? About 100,000 accounts in October. Seriously, minus 100,000 accounts. And when does that happen? Well, it happens when the market tanks. Certain investors just go, you know what, I've had enough. This sucks. I can lose money more quickly myself, and I'm really good at it. And therefore, I'm going to close my account. And it's quite tragic, really, because it just means we have failed those retail investors by not giving them adequate information. We have failed them by not explaining and having them understand how markets move, what makes a stock a good stock, what makes a stock a bad stock, what makes a risky trade, what's a not so risky trade. And it's a pretty dire state of affairs. Now, it's also a bit of an indicator of market bottoming, because this happens when people have had enough and the pain is just so great that they've all left the building. So that's unfortunately where we are right now. Now, what I was talking about just now, that the US 10-year, which is the treasuries, right, the government bonds, are this one here. The NASDAQ is the orange line here. If you invert the US 10-year, which is what's done here, so this down here is 4.4%, and this up here is 1.1% yield on the 10-year. You can see there's a very, very close correlation, right? So basically, this continues to be all about the Fed. If these rates go towards 5% or even slightly higher, then the tech market will continue to tank. If my unemployment numbers that I put up above, or employment numbers rather, prove out to be the manipulated, corrupt mess that they appear to be, then actually that would be good for tech. So think about that. This is from David Sachs. He's the former CEO of PayPal, part of the PayPal mafia. He says, it feels like the economy is heading, he's an optimist. He's heading off a cliff right now. In our larger portfolio of companies, I can see the trajectory. After Q1 board meetings, 1/3 were missing numbers, so missing expectations. And after Q2 board meetings, 2/3 were missing. And after the Q3 board meetings, the entire portfolio is reforecasting, as in missing expectations. Even the best companies are seeing major headwinds. This is an economy-wide slowdown. And that's what I'm talking about. Like, if you lose 250,000 jobs in a month, which is entirely possible given the massage numbers, then you get an actual slowdown, which again is bad for everything. Now, there is some positivity here, and that's very little equity was issued, which is good. So it doesn't dilute the market very much. Second lightest month of issuance year to date. Buybacks are going to rise to about 4 to 5 billion a day as the earnings come in, blackout periods finish. Hedge fund positions, however, are now at 41% of leverage. So they're kind of like hedge funds use leverage, right? They borrow money. That's pretty light. So it's, yeah, just very light. I think that'll be the summary. So that means that they have a lot of access to funds and capital that they could deploy should they choose to deploy it. Now, when are they going to choose to deploy it? Well, when the macro turnarounds happen. So, for example, when we suddenly start to see 250,000 job losses in a month, that's when the hedge funds are going to be like, ooh, this is exciting stuff. This is what we live for. Man on the street, unemployed, right? And so that's kind of our, yeah, it's funny, isn't it? Because they tend to make money off retail. So they're sort of the enemy. But if you watch what they're doing, you can also make a lot of money out of it. Now, CTAs, which are essentially funds that trade on technicals, so kind of charts and algorithms, that sort of thing, they are short, literally short. They're shorting the market. So they're basically here. So what does that mean? Well, it's not good for the present market, but it's actually quite positive if you have a little bit of a longer term horizon than the end of today. If you need to make a lot of money by the end of today, then you're in a tough spot. Sorry to say, but very little you can do about that. But if you look at that line where we are right now, so in 2019, where the market turned around, 2016, 2012, we were approximately in these kind of levels, as in these kind of technical funds, which is a lot of money, just weren't really in the market, or they were shorting the market. So that's all you need, is that tinderbox, that little spark to get these guys to turn around. If you look at the VIX, this is one of my favorite things to look at. I know a lot of stock investors just think it's a fear index, and then that's all it is. But it's now down for 15 days, despite S&P slow down sharply. Friday market marked the first day since 2012 where the VIX and the SPX both closed at 10-day lows. No bear market has ever bottomed without the VIX at 45 plus, says Kobesi. I am not sure I'm entirely in line with him on that, but he's sort of roughly on the right trajectory. So I put out here, let me see how big I can make that for you so you can still see it. This is 1995, just to give you a bit of a perspective. This is 2011, and this is now, right, 2020. So the blue line is the VIX. That erratic monster is the VIX. And then the orange line is, yep, you guessed it, is the S&P 500, SPX. So what do you see? Well, what I see is that when the market bottoms, and let me put a few lines in here, if I may. That's probably the market bottom. Okay, my line was not straight enough. Microsoft is a tough paymaster. There we go. Here's another one from 1998. There we go. You kind of get the idea, right? When markets bottom, the volatility is typically at sort of 40. This is the 40 line for VIX. And at the moment, volatility is at 25. So we are not at a market bottom from a panic fear point of view. Now, what's this green trade, you wonder? What's the green line? The green line is my VIX trade. Basically, I make money as long as VIX stays below 33. That's my present trade, which is looking pretty good. So literally anywhere here, I'm making money. So very, very, very little periods where we were above that. So it's a pretty nice 80 sort of probability point trade. So what does the whole thing say to you then? If you mix it all together, we're going to get onto the Palantir earnings in a second here as well. So I know a lot of you guys follow that stock. I think there is a huge potential for a massive rally, but it's all about macro. And really, once we get over the midterms today, be very, very interesting to see whether the Labor Department will revise their figures and suddenly find a couple of 100,000 extra people who lost their jobs. Because that's kind of what the data is saying to me, is that there is a load of, manipulation, corruption, or the usual, politics. I think that was the word I was looking for. Lots of politics going on here in the figures, because the establishment survey, which is the Labor Department survey, are showing we've got 2.3 million extra jobs since March, and the household survey is showing we have added basically 0 extra jobs since March. And that should be helpful for incumbents in the White House. So that's kind of where we are with that. Now let's have a quick look at, and then of course I'll be super happy to take your questions. So put them in the chat, and let's do some Q&A as well. So where are we? Okay, Palantir here. I did the fastest research you can do is follow a few smart people on Twitter and then fact check. So Palantir numbers, okay, not great. I wasn't expecting them to be great. Continues to be optimistic for the future, he says, after many such quarters, but I'm a permanent optimist. So revenue grew 22% year over year. That's bad, right? We need that figure to be 30% plus. US revenue grew 31%. So, okay, US commercial revenue, 53%, government revenue. That's the problem here. This is the great big problem, that the US government is being really slow with its defense contracts. Earnings per share were missed. Revenue was actually better than forecast. The market was pretty pessimistic on that. So that's a win in a sense. There are some positive numbers once you look beyond the headlines, but most people don't. So the total contract value by quarter, it's a big juicy quarter, and therefore you get more cash coming in the future, right? That's kind of the way that works, contract value versus cash received. Here's a nice little summary of it, essentially. Some beats, absolutely, on revenue and operating income looking good. Also, the guidance on operating income and margins looking good. They're guiding a 15.7% operating margin, which is, it's getting there, better than expected. But people are still going to hit them over the head for the EPS and for cash flow here from operations. So it's not really. Let's have a look at what they're doing. The stock's doing live. It was definitely down a bit, 2.1% down, which isn't a lot, but on a day where a lot of stuff's flying, NEO up 3.6, Meta up 3%, cutting jobs is meant to give you that reaction. It's not great, but it's also not terrible. Let's see when people actually wake up from their, whatever induced slumber, and see what the reaction is to that. But it's not. It's kind of as expected. The government business is too slow to really let them report significant numbers the way they want, and the business implementation scale it's just slow, right? To get all the government contracts in Europe and stuff is just slow. What isn't slow is making money trading. We can do that a heck of a lot quicker. So we're up 114% on the year so far. We made a little bit of money in November as well, which isn't actually showing up here yet. Where did my line go here? So to learn how we make that kind of money, to learn exactly my strategy and my trading protocol and everything else, give us a ring at felixfriends.org/coaching. You can learn directly one-on-one from me and my amazing team of investment bankers. And what do you need for it? You need a 5-figure portfolio. That's sort of our entry requirement. So if you have that, if you're 6, 7, 8, 9, whatever figures, give us a ring at felixfriends.org/coaching. If you're just getting started with investing, brilliant. That's the most exciting and the most important thing you can possibly do. Go to Master Options program, felixfriends.org/options. There it is. And you get access to a 100 lecture plus program. You get to see me trade live every week. So you can get to see me implement exactly the strategy, how I do it. You have daily chat support and everything else. It's a wonderful community of thousands of students who are learning how things really work. It'll also open your mind to becoming a better stock investor, I always think. I think the two are highly correlated. You can't really do one without the other. Now let's do a quick recap for those of you who just joined here. So there are 2 measures of job creation. And we've been looking at week after week after week. Oh my God, there's so many jobs created. No one's unemployed. How is this possible? My cat is agreeing, meowing in the background. There she is. This is Tallulah, chief financial analyst around here. Does most of the thinking, don't you? Do you do most of the thinking? I think you do most of the thinking. So how's that possible? Well, if you look at the household survey, she's cold. That's why she's making that racket. The red line here, you can see that there was a massive divergence. Normally they give us pretty similar numbers, but miraculously, here, 6 months before elections, the numbers separate. And we see the official government figures from the Labor Department showing 2.3 million jobs were created. Isn't the American economy strong? And don't you have an omnipotent, all-knowing, benign leader in your leadership? And then you look at, well, this is the official Biden Labor Department numbers, 2.45 million jobs created. this is what the household survey said was created. So a bit of a gap, right? Bit of a difference. Now, has that ever happened before? Yes. This was when President Obama was re-elected. So he was already the incumbent in the White House. And you get that massive, massive separation here, pretending 1 million jobs or something like that were created that weren't. And then, well, when I was going to say President Hillary, but that never happened, did it? When Secretary of State Hillary Clinton ran against Trump, same thing happened. You get this funny separation in data. And I'm sure it's entirely coincidental. I'm sure the Labor Department has a very, very good explanation for it that has nothing to do with corruption, undue influence, or any other sort of malfeasance on the part of politicians, because I'm sure they're entirely honest and upstanding members of society. But it is a little bit peculiar. And then when you look at the data on a deeper level, and you see that actually we were destroying jobs. These are the full-time jobs being destroyed, and the jobs being created are just part-time jobs. And counting them as full-time jobs, or the same thing, is rather misleading. So essentially what's happened since March this year, the US economy has lost about 500,000 jobs, and it's created about 500,000 jobs, part-time jobs, which isn't quite the same thing. And then you've got a bunch of people who are working multiple part-time jobs because the part-time jobs aren't paying enough. So just because you're flipping burgers on a Saturday does not make you employed, in my view. So that's kind of what we got there, shenanigans going on. And what does that mean for the market? Well, I sort of ran through it here in a rather shabby fashion. At some point, you're going to have to see a correction in that data, if the data is indeed as it says it is. So say in December or something, miraculously some point after the midterms, the Labor Department comes out and says, gosh, we lost maybe 500,000 jobs or something this month. How did that happen? We're not quite sure, but economy is slowing down. Then the Fed suddenly has an excuse to hike their rates less, which would also, by coincidence, stop the US government from going bankrupt over the high interest they'd have to pay. So say the interest then expectation drops below 5 percentage points. And then what happens? Well, the market will rally. So say a 1% cut in rate expectations would give us about a 9% rally in the market, especially in the tech market, QQQ, that sort of thing. And the kind of archetype portfolio should do quite well in that scenario. Now, once that happens, we will all sit down calmly over whatever it is that you like to drink, and kind of think this through and go, hang on a second. If people are losing their jobs at this rate, and we still have high inflation, there isn't going to be an immediate bailout. The US government could spend lots of money, but depending on how the midterms come in today, are probably going to be not particularly in a position to do anything, which could be really, really good actually for the market. Then what's going to happen here? Well, the economy is actually going to slow down. People are actually going to spend less money. There won't be a bailout. Interest rates are still high, even if they're only sitting at 4%. And people are going to lay off more people. People are going to spend more money. People are going to worry about that. And the real economy is going to slow down. So anything to do with the real economy and present cash flow from consumers is going to slow down. And therefore, your S&P and your Dow Jones companies, they're kind of the real world people who actually make things and sell them to people, not just people who come up with concepts and collect cash for it up front. Those stocks are going to start to hurt. And you are going to see the stock market decline some more, like you should in a recession. But that doesn't mean the tech isn't going to do slightly better. So that's kind of the way I see it. That doesn't mean it's going to happen exactly that way. I certainly haven't got my crystal ball yet. I keep ordering it on Amazon, but they never deliver it. And I think it could be a rather interesting next couple of months. Now, what's going to happen? What's guaranteed? What's the guaranteed outcome? The guaranteed outcome is high volatility. Because all of this data, any kind of data shocks and changes in policy are going to cause volatility. And it is going to shoot up that lovely VIX chart that I had here. Where is it? There it is. And it's finally going to give us some real volatility. Make VIX go back up to here somewhere, which will, to some extent, tank the market. But it might also, at some point then, when it goes over 40, sort of signal the bottom of the market. Now, what happens when volatility is really high? Options premiums are really expensive. So to buy options becomes really, really expensive. but to sell options becomes very, very, very profitable. And that's basically the game that we're in, to sell high profit, high probability, 80% plus probability options and collect a load of money. That's what we've been doing for quite a few years. I say me, my golden retriever and my cats. And it's a really, really nice income stream. It really is. It's a lovely one. So let me take some questions here. Best crystal balls are on Etsy. Okay, I should get one of those. One of those handmade crystal balls, right? From a witch nearby. If jobs are not increasing, why are we still increasing interest rates? Because the data, the official data shows it. And that's the data the Fed goes by. Cooking the books. Someone's always cooking the books. And Robert, it'd be very interesting. Very, very interesting to watch this space. Watch how the data changes in the next couple of weeks as there isn't this impetus to get reelected. Is that a cat in the background? Yes, definitely. There's several, in fact. Why 24 for 24 hours? U.S. elections. Chinese stocks. So there is lots of data out from also JP Morgan and so on, essentially saying we might see a 20% rally in Chinese stocks on a reopening. We didn't quite get that confirmation on Saturday. Chinese government essentially saying we're going to stick with COVID zero. But in a more refined fashion, so that the important part here is going to be in the details. So hopefully they're going to refine it in a way that allows people to manufacture iPhones and that sort of thing at a higher level. Looking good for a rally after the US elections. Okay, let me just see if we get any questions here. John, it's a good question here. You would expect CPI to start coming down. CPI also a lagging indicator, though in October, I think oil prices were somewhat strongish, right? WTI. Let me just get rid of the SPX here. So hang on. Let's make this a day chart. So yeah, it's still, compared to where we were last year, or rather the peaks here, you would think that the basing effect should be positive for inflation numbers, right? Very much so. Now someone's just rang my doorbell again. Crikey, hard to believe, hey? You'd think somebody could open the doorbell. 1 second, guys. Right. You know what I need? I need one of those little robots that answers the front door. That's what I need. Or train Winston to open the front door. That might be more useful. CPI data when, let me have a look. And yeah, leave the chart. So what have we got coming out in terms of data? The Fed presidents are talking again today, which means, you know what they're going to say. Wednesday, nothing majorly important. Thursday, we get the inflation data out. So CPI, this Thursday. That's going to be important. At the same time, we also get jobless claims coming in and a bunch of Fed presidents on tour. Friday, Michigan consumer sentiment, which is also somewhat useful. And then going into next week, PPI, producer price index. It's more forward-looking, or less backward-looking might be the better way of putting that. Next Tuesday, next Wednesday, retail sales data, industrial production, and on Thursday, European inflation. That might be less important to you unless you're based here in Europe. So yeah, lots of data coming out, but really watch out for Thursday. Thursday is the biggie, the inflation rate there, to see what that comes in at. Steve asking about Palantir results. Hang on, I've got the screenshot of that. Q4 forecast, they're expecting 504 million. The consensus was 5 or 6. I mean, it doesn't really matter, 1 or 2 million off. Honestly, I don't think that the difference is big enough for that to really make any difference. You need a Tesla bot, absolutely. Ira, thanks for the reporting live from the ground, live from Times Square. Ira, he's counting people spending money. You know, with all the money that's been dished out in recent years by governments, and people are sitting on a lot of savings, much more so than usual. So yeah, they still have that money to spend, but it becomes at some point sentiment changes, and that's why the consumer sentiment numbers, the Michigan one numbers, are quite important. If you get out a headline saying 250,000 people lose their jobs, suddenly sentiment changes. And look at what Meta is doing today. Look at what Twitter is doing. Like, that has an impact, because suddenly all these people who are actually sitting on a lot of money, those guys are all pretty well paid, right? Stock options and so on. And they're suddenly like, hang on, my stock options have tanked. I'm losing my job. I can't just waltz into Facebook or Google and get a job, which I always could. Very few companies are actually hiring. At some point, there is enough of that bad news in the media that it does change the narrative. And then even though people have money, they'll stop spending it or they slow down. Are you going to wait until Thursday to sell options, says Jerry Tiger? Probably not. I'll probably do some trading before. I'll let you guys know. Of course, always on the Discord. Why? Because yeah, I mean, I think I wouldn't trade short-term options. I wouldn't set up a trade for like Friday or something like that. I think that would be madness. But if you set up a trade for, say, 45 days out, then I think you could quite nicely trade around that data. So we just have to see what we find in terms of opportunities here. Ira, you're a popular man. It's lovely to have you on the chat. It's nice to have you on a Saturday as well. How can Meta be up when they're firing people right, left, and center? Stefan, welcome to the cold-hearted world of capitalism, where when you fire people, the stock market applauds you. That's how it works. Watch The Wolf of Wall Street from the 80s. Why? Because you're cutting costs, you're improving margins, and therefore your ice cold-hearted shareholders applaud you, because for the first time, you're going to do something about the 90 billion expenditure bill that Meta has. 90 billion. They have not fired a soul since 2012. They've literally increased their headcount continuously since 2012. Look at this chart. Look at that. I mean, do you think that is going to cause some inefficiencies, some wastage? Yes. Now, is it going to be nice for the employees? No. 87,314 by last count. It'll apparently be a few thousand less in the next few days. So why do they do that? Well, they have to do it because Meta is getting tanked. It's getting hammered. Look at the stock chart of Meta. Where did it go? What happened to our stock chart? SPX. If this is your stock chart, then this is a weekly chart. You kind of haven't got a choice. You got to cut some costs, because that's what the market hates about Meta at the moment. It's not actually the business. It's not really anything to do with that. It's margins declining and costs just spiraling completely out of control. What's your Discord link? Says Iceman. You can get there through the Patreon, felixfriends.org/Patreon. That's the way you get there. Iceman, appreciate you asking. Santa Claus rally, possible. It is still possible, very much so. Why? Because we've got all this cash on the sidelines. We've got the big funds who are basically short. Global CTAs are short. CTAs are funds that are trading on the basis of technicals, so particular technical indicators that they look at, some fundamentals, but mostly technicals. They are actually shorting the market. So they could turn that around, right? They could be long on the market. And again, if you look at how much long-short funds are in the market, is very, very little leverage and very, very little long exposure. So there's a lot of money that could be deployed. You get 4 to 5 billion in buybacks every single day. Now coming out of the earnings season. So there's a lot of reasons for that the market could go up, but it's not looking quite as bullish as it was about 10 days ago. Investors are hoping they're going to fire people working on the metaverse. Yeah, I think that's probably fairly unlikely. I think they're going to fire lots of other people. I don't know. Maybe they're going to just have them working in the metaverse. Virtual employees, wouldn't that be something? What if Santa ain't real though? Well, okay, what's the worst case scenario here? The worst case scenario essentially is inflation reading on Thursday comes in high, and therefore the market expects Fed rates to go to say 5.5%. So the market loses another 5% or so, S&P that is. Tech stocks will probably bleed a bit harder. And we go into the end of year looking rather glum and gloomy. But at some point, people are going to get laid off. And if you watched the beginning of this and saw the shenanigans, politics going on with Labor Department numbers, I think there is probably some data out there that's a lot worse than what we're seeing. So I'm always an eternal optimist. I think contractions in demand are good. It means, people lay people off, and that sucks for the people who get laid off. But it does make the companies more efficient. It means that the bad businesses units get closed. It means the bad businesses either close or they get bought by the better businesses, and therefore they get better management. It's just we haven't had any of that for about 10 years because the governments thought we couldn't handle it. So we've got this kind of bubble going on of lots of companies that really shouldn't be out there, that are just appallingly run. I mean, look at Peloton or something like that, right? Stefan, I saw that about Carp. He's sort of saying that basically you need Palantir for the metaverse, right? Isn't that not the sales pitch? John saying, I only trust Rudolph the red-nosed reindeer with my portfolio. Won't you guide my stocks tonight? We're gonna have to come up with some Christmas themes, aren't we, for the next few months? That's going to be nice. Any questions, guys? Throw them in the chat. That's where we do a Q&A. I'll take a couple more. Just put them in there. Get typing. You only need to hit the subscribe button to be able to type. Should have bought orange juice. It doubled in a year. Mike, really? Yeah, we should really just start an orange juice fund, shouldn't we? All in, and you have to consume several gallons of the stuff a day to drive demand up. I think it's to do with the last hurricane you had. I think that did some serious damage in the south. Best country to move to in Europe to avoid paying taxes. By avoid, I think you mean to optimize your tax structure in a highly legal and ethical manner. There are a couple of, quite a few kind of European countries that have tax structures, Italy, Portugal, Malta, that have quite tax efficient processes. It really depends on what you're doing, what you're going for, how your income is set up, whether you're retired or not, and so on. There's a quite a bit to that. So do some digging and drop me a line, Fluffing Fluff. SoFi options this year. Yep, SoFi is introducing options trading by the end of the year. That'll be quite exciting. Hopefully they do a good platform, because no one's really done a really good options trading platform. So I look forward to that. And if that works, I might add it to our teaching as well. I'm sure I will, in fact. Yeah, you see, you've got some Romania, don't pay any tax. Portugal for digital nomads. Dubai, very true. Just not quite in Europe, but yes, very true. Puerto Rico as well. West Europe, that is. Spain are going to do a nomad visa as well. Okay, interesting. Portugal, don't you like Tasty Trade? No, they do a decent job, Tasty Trade. They do. At least they understand options. But most people out there trading on interactive brokers or Thinkorswim, which do the job. It's just not it's not wonderful, is it? It's just like driving a, I don't know, 1970s built in Russia kind of a vehicle to get down the road. It'll get you there, but it's just not particularly brilliant. Nomad visas would be ideal for options traders. Yeah, you can be anywhere. I mean, look at Jerome. I saw him in the chat earlier. He's on a boat in the Caribbean. What's your tax domicile there? Wherever it's the sunniest, where the beaches are the whitest. Kyle likes his 1990s platform. Another one of my coaches. Appreciate you being on, Kyle. You get comfortable with it, right? You get to sort of, you get to like it after a while. UK tax laws around options. Well, you just have to pay tax on the gains, but it's better to have gains and taxes than to have no gains. I always think. So focus on the gains and then optimize the taxation. If you're in the US, by the way, you can trade options in Roth IRAs. That's not tax advice, but you can. I have a lot of coaching students who do exactly that, which is wonderful. When is the daylight saving going away? I know, if somebody could do something about that. I mean, literally, Europe does it 2 weeks before the US. Do you know how confusing that is? You know that my schedule is all like Zoom calls and meetings and stuff, and they're all in different time zones. And you wake up and you're like, I have no idea what time this meeting is meant to take place in. Absolutely no idea. So yeah, I wish they could get rid of that. I'm not a UK tax advisor, but I would imagine that you could offset losses against gains. Come to Greece, no one pays any tax. I know, that's funny, Howard. Okay, guys, lots of other questions there. If you want to watch a recap of what this is really about and the massive manipulation in the Labor Department numbers and what that really means for the market, go back to the very beginning of this video, watch the first 10 minutes of it, and I'll run you through it. I hugely appreciate you watching and tuning in. Your desire to become a better investor is what counts and is what is going to get you there. To learn much more, learn from me directly and my team, go to felixfriends.org/coaching. We have coaching programs for 5, 6, 7, 8, 9-figure portfolio investors. So if that's you, give us a ring at felixfriends.org/coaching. If that isn't quite you yet, if you're getting started, brilliant, get started. That's the most exciting part of the journey, really. Go to felixfriends.org/options, access to 100 pre-recorded lessons. You get to watch me trade live every week. You get to see the full protocol strategy for risk management and everything else there. felixfriends.org/options, daily chat support and everything else. Check it out. I appreciate you tuning in, and I look forward to seeing you on the next one.